Hi there, it's Friday the 10th of May 2019. I'm Steve Towers. Welcome to ITB, coming to you today from Taiwan. Let's get started. Well, the China-US trade war has started again. Today, the 10th of May, the US has increased additional customs duties on approximately $200 billion of imports from China, from 10% to 25%. The increase to 25% was originally scheduled to take effect on the 1st of January this year. However, it was postponed on 2 occasions, with the second postponement being until further notice. Well, the further notice has now been given. The reason for today's increase is stated in this week's notice issued by the US Trade Representative. The United States is engaging with China with the goal of obtaining the elimination of the acts, policies and practices covered in the US trade investigation of China. The leaders of the United States and China met on December the 1st, 2018 and agreed to hold negotiations on a range of issues, including those covered in the investigation. Since the meeting on December the 1st, the United States and China have engaged in additional rounds of negotiation on these issues, including meetings in March, April, and May of 2019. In the most recent negotiations, China has chosen to retreat from specific commitments agreed to in earlier rounds. In light of the lack of progress in discussions with China, the President has directed the Trade Representative to increase the rate of additional duty to 25%. And there could be more. President Trump said this week that the US was starting the paperwork to increase customs duties on a further $325 billion of imports from China. Meanwhile, a Chinese government official was quoted by the Wall Street Journal as saying that China's retaliation might not be in the form of additional customs duties, due to the fact that China's imports from the US are significantly less than the US's imports from China. The exact cutover from the 10% rate to the 25% rate is explained in a release from the US Customs and Border Protection Agency. For a copy of that release and a copy of the notice issued by the US Trade Representative, please go to our website or app. The Cayman Islands is the latest no or only nominal tax jurisdiction to provide further guidance in regard to its economic substance legislation. It has released a second version of its guidance, Economic Substance for Geographically Mobile Activities. For a copy of this document, please go to our website or app. The IMF has issued a policy paper on carbon taxes, which argues that they are a better way to deal with climate change than other potential responses, such as cap and trade. For a copy of the paper, please go to our website or app. And yes, that's right, there's nothing to report this week on digital taxation. Australia will have a general election on the 18th of May, And at the moment, it looks like the opposition Labor Party will win government. The Labor Party has issued a press release indicating that they will introduce legislation to deny deductions for outbound related party royalty payments by multinationals in situations where there is a low amount of foreign tax payable on the royalty income, unless the taxpayer can establish that the payments are not made for the dominant purpose of tax avoidance. For a copy of the press release, please go to our website or app. Also in Australia, the tax authorities have issued guidance in regard to the recently enacted amendments concerning stapled structures. For a copy of the guidance, please go to our website or app. In India, the Bombay High Court has decided an interesting case in regard to the capital gains article of the India-Mauritius Treaty. The case is called Indostar Capital. The taxpayer is a Mauritius Category 1 global business licence company. It holds a tax residency certificate issued by the Mauritius tax authorities. The taxpayer was incorporated in 2010 to act as an investment holding company for a range of institutional investors. Its only substantive asset is a shareholding of about 90% of the shares in an Indian resident company. Those shares were acquired from 2011 to 2015. In 2018, the taxpayer decided to sell some of its shares in the Indian company. It applied to the Indian tax authorities for a Section 197 certificate, which would allow the Indian purchasers to pay the purchase price to the taxpayer without deducting tax. The Indian tax authorities issued a Section 197 certificate, but the certificate required the purchasers to withhold approximately 8% of the purchase price. The taxpayer sought to have that decision reversed and the issue of a fresh Section 197 certificate with no tax required to be withheld. Now, you might be wondering why the taxpayer would not be exempt under the capital gains article, Article 13, of the India-Mauritius Treaty. Well, the short answer is it would be. Even though that provision was changed in 2016 to remove the exemption on the sale of shares, there's a grandfathering rule in regard to shares acquired before the 1st of April 2017. The taxpayer would satisfy that rule. All of its shares in India Co. were acquired before that date, and therefore Article 13 would provide an exemption from Indian tax on the sale of shares in India Co. However, the tax authorities argued that the anti-avoidance principle in the McDowell and Vodafone cases applies to these facts. In other words, that the whole structure, including the formation of the taxpayer, the acquisition of the shares in the Indian company, and the proposed sale of those shares, was a colourable, artificial tax avoidance scheme. If that principle does apply to the facts, then, according to the tax authorities, the treaty exemption is not available. The Bombay High Court decided that there was insufficient material before the tax authorities to support the view that the anti-avoidance principle applies to these facts. The court therefore held that the taxpayer should be issued a Section 197 certificate which requires no tax to be withheld. However, as this case concerns only the Section 197 certificate and it does not concern the final assessment of the taxpayer, the court decided that the taxpayer needed to provide security to the tax authorities. It therefore ordered the taxpayer to maintain a minimum level of shareholding in the Indian company, until the normal assessment period expires in 2021. For a copy of this case, please go to our website or app. The Bangalore Income Tax Appellate Tribunal has decided a case in regard to subscription payments made by an Indian company to a US company to access online data in regard to pumps. The issue was whether the subscription payments satisfied the definition of fees for included services in Article 12 of the India-US Treaty. The tribunal held, correctly in my view, that they do not, and therefore the payments were exempt from Indian tax under the Business Profits article of the treaty. Now, you've probably heard me say this before. I'm surprised that the tax authorities didn't argue that the subscription payments fell within the definition of royalties in Article 12, on the basis that they were payments for information concerning industrial, commercial, or scientific experience. For a copy of this case, please go to our website or app. And also in India, the controversial advance ruling which was given to vServe Global in November last year in regard to GST on back office services provided to a non-resident company has been confirmed on appeal. Let me remind you of the facts. An Indian service company provides various services to its client, a Hong Kong trader of chemicals and other products. The services include liaising with buyers and sellers of those products. In other words, companies which buy the chemicals and other products from the Hong Kong trader and companies which sell the products to the Hong Kong trader. Those liaison services include creating and arranging legal documentation, for example, purchase orders, sales contracts, invoices, to be exchanged between its client and the buyers or sellers, processing payments for the client, arranging for original documents to be sent to the buyers and sellers, arranging inspection certificates on behalf of the client, and coordinating with the buyers and sellers to execute the sale and purchase contracts. The Indian service provider is paid a fee equal to $380 for each sale or purchase transaction handled, subject to a minimum of $10,000 per month. Based on these facts, prima facie, the place of supply of the services would be outside India, and therefore the services would be zero rated for GST purposes. However, under the Indian GST law, the place of supply of the services of an intermediary is the location of the intermediary, which would be India in this case. Thus, if vServe Global is an intermediary, its services would be subject to 18% GST. The term intermediary is defined in this way: a broker, an agent, or any other person, by whatever name called, who arranges or facilitates the supply of goods or services, or both, between two or more persons, but does not include a person who supplies such goods or services, or both, on his own account. The Maharashtra Authority for Advance Rulings decided last November that vServe Global satisfied the definition of intermediary. That decision has now been confirmed by the Appellate Authority for Advance Rulings. The Appellate Authority also held that all of the services provided by vServe Global to the Hong Kong trader constitute, for GST purposes, a composite supply, of which the intermediary services is the main supply. For a copy of the Appellate Authority's decision, please go to our website or app. In New Zealand, the tax authorities have issued the final versions of reports on various aspects of the BEPS legislation, which was enacted in June 2018. The reports were originally issued in draft form in August 2018. There are 5 final reports: interest limitation, hybrids, transfer pricing, permanent establishment, and administrative measures. For a copy of all of the final reports, please go to our website or app. In the Philippines, the fate of the government's Trabajo bill might be determined by the results of the midterm elections, which will be held next Monday. 12 seats in the Senate are being contested. You'll remember that the Trabajo bill will progressively reduce the Philippines' corporate income tax rate from 30% to 20% over the next 10 years, if it's passed. In Belarus, the Supreme Court has issued instructions to lower courts in regard to the interpretation of the country's GAR provision after amendment by a presidential decree in April. For a copy of the instructions, please go to our website or app. Belgium is the latest EU member state to announce a reduction in the VAT rate for online publications. The rate has been reduced from 21% to 6%, effective the 1st of April 2019. In Denmark, the tax authorities have issued, for public comment, a draft bill which would abolish the preferential interest deduction regime for hybrid instruments which qualify as Tier 1 capital for financial institutions. Instead, the general tax rules will apply to these instruments. The tax authorities have not allowed a long time for public comments to be given. The deadline is tomorrow, the 11th of May. For the link to the tax authorities' website on this matter, please go to our website or app. The European Court of Justice has decided a VAT case concerning the time at which a service is supplied. Under the EU's VAT directive, VAT is to become chargeable when the services are supplied. The taxpayer is a construction and installation service provider. It argued that its contracts are required, under professional rules, to include a condition that the customer must provide a formal validation of the work performed. Therefore, it argued that the time at which its service is supplied is the time of that formal validation by the customer, even though the taxpayer's work might have been completed at an earlier time. The court agreed with the taxpayer's argument. It said this: accordingly, provided that the acceptance of the work has been stipulated in the contract for the supply of services, provided that such a requirement reflects the conventional rules and standards in the field in which the service is supplied, it must be held that that requirement is itself a part of the service, and that it is therefore decisive in determining whether that service has in fact been supplied. For a copy of this case, please go to our website or app. The European Court of Justice has also decided a case, A. Fons, on a reference from a Netherlands court in regard to the free movement of capital and state aid. Well, actually, it didn't really decide the case. It ruled that the Netherlands court should not be asking the question because, on the facts of the case, the Netherlands court is not permitted to consider the free movement of capital and state aid issues. They are in the exclusive competence of the European Commission, subject to review by the European Court of Justice. Key to this ruling is that, on the facts of the case, the two issues, the free movement of capital and state aid, are indissolubly linked. For a copy of this case, please go to our website or app. You'll remember that in March this year, the European Commission announced that it has opened an in-depth state aid investigation into the tax rulings granted by Luxembourg to the Finnish food and drink packaging group Huhtamäki. Well, the Commission has now released the full non-confidential version of its decision to open that investigation. The document sets out the facts concerning Huhtamäki's group financing structure, the three Luxembourg rulings, and the Commission's preliminary analysis of the state aid issue. According to the document, the group financing structure is this. Huhtamäki Ireland made an interest-free loan to Huhtalux, a Luxembourg group finance company. Huhtalux in turn made interest-bearing loans to group companies in the US. Under the first of the three tax rulings, Huhtalux was allowed to deduct notional interest on the interest-free loan, so as to give it a taxable profit margin of 9.37 basis points. Under the third ruling, the taxable profit margin was set at 3.75 basis points. As you know, the Commission's preliminary view is that the tax rulings constitute illegal state aid, and that's the reason it has opened the in-depth investigation. For a copy of this document, please go to our website or app. A consortium of journalists has released a report on EU carousel or missing trader VAT fraud. For a copy of the report, please go to our website or app. In Lithuania, the government has proposed the reduction in the standard VAT rate from 21% to 18%. Which was its level before the 2008 financial crisis. In the Netherlands, the Court of Amsterdam has decided a case in regard to deductions for high-rate interest on convertible debt. The taxpayer company was acquired by a French private equity fund. It then borrowed from investors in the fund in the form of subordinated debt, which was convertible into the company's equity. Notably, the convertible debt carried a high interest rate, 13% per annum. That level of interest caused the taxpayer company to have a tax loss each year. The tax authorities argued that the convertible debt should be treated as equity for tax purposes. However, that argument was rejected by the court, which stated that the legal form of the transaction should be respected. The tax authorities also argued that the interest rate breached the arm's length principle. However, the court accepted the taxpayer's transfer pricing report, which indicated that the rate was not excessive, based on benchmarking with subordinated debt transactions between third parties. For a copy of this case, please go to our website or app. In Switzerland, the tax authorities have released for public consultation draft guidance in regard to the VAT treatment of foreign companies and the VAT place of supply for services. Notably, the draft guidance confirms that VAT-registered foreign companies are required to report their turnover in regard to their supplies in Switzerland and not worldwide turnover. This was a matter of some concern. For a copy of the two items of draft guidance and the link to the consultation website, please go to our website or app. In South Africa, the tax authorities have released for public comment draft rules and procedures in regard to the implementation of the carbon tax, which will be effective on the 1st of June 2019. Public comments have been requested by the 31st of May. For a copy of the draft rules and procedures, please go to our website or app. In Zambia, the tax authorities have published on their website information concerning the proposed sales tax, which will replace the VAT regime on the 1st of July 2019. There are two items of information. The first is a frequently asked questions document about the new tax. And the second is a very long list of goods and services which are proposed to be exempt from the sales tax. The list has 1,300 items based on HS codes. The purpose of the exemptions is to reduce the cascading effect of sales tax. For the link to the tax authority's website, please go to our website or app. In Saudi Arabia, the tax authorities have issued guidance on the VAT treatment of the oil and gas sector. For a copy of this guidance, please go to our website or app. In Canada, the Saskatchewan Court of Appeal has held by a 3-2 majority that the carbon tax legislation, the Greenhouse Gas Pollution Pricing Act, which was passed by Canada's Parliament, is constitutional. For a copy of the case, please go to our website or app. Also in Canada, the country's Auditor General has issued a report which warns of the GST losses from e-commerce, in particular low-value imported goods and digital services. The focus is on GST. There's no reference to a digital services tax. For a copy of the report, please go to our website or app. In Peru, the government has published a decree which provides guidance on the country's GAR provision. For a copy of the decree, please go to our website or app. In the US, Treasury and the IRS have released proposed regulations in regard to disposals by foreign persons of interests in partnerships which are engaged in a US trade or business. The focus of the proposed regs is on withholding and information reporting. For a copy of the proposed regs, please go to our website or app. The European Commission has provided comments to the IRS in regard to the proposed FDI regulations. The comments argue that TCJA Section 250 and the proposed implementing regulation on FDI are 1. Most likely breaching US obligations under the World Trade Organization, WTO, and other international obligations, and 2. Not fit to reduce tax avoidance and aggressive tax planning. For a copy of the Commission's comments, please go to our website or app. The US Court of Appeals for the Third Circuit has decided a Subpart F case in regard to loan guarantees provided by two CFCs. This decision is interesting for two reasons. Firstly, the court confirms the validity of Subpart F regulations which were issued in 1964. And secondly, the court confirms that the Subpart F inclusion is not to be treated as dividend income, and therefore it does not qualify for a special tax rate which applies to dividend income. For a copy of this case, please go to our website or app. And now for this week's treaty developments. We've had 2 treaties enter into force and 1 protocol enter into force. I have 2 articles for you this week. The first article is called OECD Profit Allocation Debate, the view from the surrender state. It's written by Gary Sprague and it's published in the Tax Management International Journal. The context for this article are the 3 proposals in Pillar 1 of the OECD's consultation document on the tax challenges of digitalisation, which was released in February and discussed at the public consultation meeting in March. All of the 3 proposals involve an increase in the taxing rights of market jurisdictions. However, in the words of the author, what wasn't much discussed was the other side of the equation, namely which country will need to surrender the tax revenue associated with the additional profit to be allocated to the market states. The author identifies a number of technical and practical difficulties in regard to the surrender state. Here's one example. Important technical issues will arise to determine which jurisdiction should be the surrender state. There is no reason to think that the surrender state always will be limited to a single state. Even if it is clear that the special allocation of profits to the market state is to be funded from residual profits arising from the creation and utilisation of a marketing intangible, there may be more than one enterprise in the group that has contributed to the creation of the various intangibles which may give rise to an overall non-routine return. If it turns out that the special allocation is to be made out of the overall non-routine return from the group, as would be the case under the user participation proposal, that would bring even more entities into play as potential surrender states. If the allocable pool turns out to be all profits of the group, routine and non-routine, as would be the case under the significant economic presence proposal, then every entity in the group would seem to be equally eligible to contribute its portion of the specially allocated profits. The second article is called A Critical Analysis of the Quick Fixes for the EU Intra-Community B2B VAT System. It's written by Matthias Horsthus, please excuse my pronunciation, and Frank Nellen, and it's published in the IBFD's International VAT Monitor. In October 2018, the EU member states agreed to adopt 4 changes, the so-called quick fixes, which are intended to simplify and to reduce fraud and abuse in the current EU VAT system for B2B intra-community trade. As the title indicates, this article provides a critical analysis of those quick fixes. The authors conclude in this way. The first quick fix on the harmonised burden of proof for cross-border intra-community transport enables taxable persons to implement one consistent procedure for collecting their transport documentation, which is an improvement compared to the currently existing patchwork of national rules. The second quick fix provides a solution for the complex and long-standing issue of transport allocation in connection with intra-community chain transactions, whereas the third quick fix entails a welcome simplification of the VAT treatment of call-off stocks. This having been said, the practical value and impact of these quick fixes is reduced considerably by extensive formal requirements. In contrast, the authors have some reservations as regards the fourth quick fix, which turns the VAT identification number into a substantive requirement to be included in the invoice for the exercise of the right to deduct input VAT. This quick fix is primarily intended to facilitate supervision and enforcement on behalf of the tax authorities, yet it complicates the legal position of taxable persons who are unable to obtain the VAT identification numbers of their customers. Well, that's the way it is this Friday, the 10th of May 2019. I'm Steve Towers in Taiwan. Have a great weekend.